While bombs rain down on Gaza and rockets fly through the sky, another battle is quietly raging in the world's markets. Oil prices spike, gold prices fluctuate, and investors scramble, all while the human cost continues to rise. Today, we're looking at more than a war of territory or ideology. We're uncovering the hidden financial war that lurks behind every headline. The moment news broke about the escalating violence in Israel and Palestine, financial markets reacted almost instantaneously. Stock prices wavered, indices dipped, and investors around the globe paused, holding their breath. The S&P 500 dropped nearly 1.2% in the first hours. European markets experienced a ripple effect, and Asian exchanges reacted with caution. Volatility, as measured by the VIX index, spiked, signaling fear and uncertainty sweeping through the global financial system. But this is more than just numbers on a screen. Every dip and spike has a real-world impact. Fuel prices rise, the cost of goods fluctuates, and families feel the pressure of inflation almost immediately. For traders and investors, these are opportunities to hedge, to gain, or sometimes to lose everything. For ordinary people, it's an invisible shockwave that touches daily life in very tangible ways. Let's examine the mechanisms behind this immediate impact. Geopolitical tensions trigger what economists call a risk-off environment. Investors sell off risky assets, such as stocks in emerging markets, and sometimes even in developed economies. They then move their capital into safer havens, like US Treasury bonds, gold, or the dollar. This sudden shift creates liquidity crunches in certain sectors, while creating opportunities in others. Energy companies, defense contractors, and commodities markets are usually among the first to respond. Sudden jumps in futures markets for oil and natural gas reflect speculation and fear of supply disruptions. Meanwhile, defense stocks may immediately rise as investors anticipate increased demand for security and military technology. It's a strange paradox. Human suffering coincides with financial opportunity for some, and global markets reflect this tension almost instantly. History has shown us similar patterns. During previous conflicts in the Middle East, stock markets have reacted within hours. Sometimes they stabilize within days, other times they enter prolonged volatility. The key takeaway is that war is not only a humanitarian crisis, but also a catalyst for rapid financial shifts that ripple across the globe. If there is one market that reacts fastest and hardest to conflict in the Middle East, it is the energy market. Oil and natural gas prices are highly sensitive to geopolitical tensions, as even the perception of a supply disruption can cause prices to surge. In the first 24 hours of the escalation between Israel and Palestine, Brent crude futures jumped by nearly 3%, and natural gas prices in Europe surged, reflecting concerns over stability in a region that supplies energy to the entire world. But why does this happen? Simply put, the Middle East is a central hub for global energy production and trade. Any hint of instability triggers fears that pipelines may be disrupted, ports may be blocked, or exports may slow down. Traders react almost instinctively, and the ripple effect is felt everywhere, from gas stations in Los Angeles to heating bills in Berlin. Let's put this into perspective. During the 1973 oil crisis, geopolitical tensions caused oil prices to quadruple, resulting in global inflation and severe economic consequences. Similarly, during the Gulf War in 1990, minor threats to supply routes caused panic buying and market volatility. Today, although markets are more sophisticated and information travels instantly, the principle remains the same. Conflict equals uncertainty, and uncertainty equals rising prices. This doesn't just affect traders or investors. For ordinary families, it means higher prices at the pump, more expensive electricity, and rising costs for goods that rely on energy-intensive supply chains. Imagine paying more for groceries not because of your local economy, but because rockets are flying thousands of miles away. The invisible connection between conflict and daily life suddenly becomes very tangible. However, energy companies see opportunity in this chaos. Stocks of major oil producers and energy infrastructure firms often rise in the early stages of conflict as investors anticipate higher future revenues. However, there's a paradox. Human suffering coexists with financial gain, and the market responds before humanitarian aid even reaches the affected regions. It's also important to note that not all energy markets respond equally. Countries with diversified energy sources or strong strategic reserves can cushion the blow, while nations dependent on imports feel the pinch immediately. Because global supply chains are interconnected, a disruption in one region can trigger price swings in markets thousands of miles away. In short, energy markets serve as a barometer of fear and expectation. They demonstrate that the economic impact of war is not abstract or distant. It touches every corner of the globe in subtle yet powerful ways. While investors may see opportunity, people on the ground face uncertainty, rising costs, and heightened anxiety. While rockets fly and headlines report devastation, another story is unfolding in parallel, one of profit and market shifts. Paradoxically, the defense industry often experiences a surge during conflicts. Investors anticipate increased demand for military technology, weapons systems, and security solutions. Companies like Lockheed Martin, Raytheon, and Israel's Elbit Systems see their stocks rise, reflecting this expected increase in demand. It's a strange reality. While families hide in shelters and hospitals overflow, financial analysts celebrate record quarterly gains in boardrooms thousands of miles away. Detached from human suffering, the stock market treats war as a predictable event, an opportunity to hedge, invest, and capitalize. Understanding this pattern, however, doesn't make it any less complex or morally challenging. Historically, this pattern repeats itself. During conflicts in the Middle East over the last 50 years, defense contractors have consistently reported increased orders, government contracts, and surges in share prices. Even minor escalations can trigger speculation in the stock market, as investors anticipate long-term military engagements and the resulting financial inflows. But it's not just about the numbers. There's a human angle that's easy to overlook. While engineers and workers in the defense sector may enjoy increased job security, the products they manufacture are directly linked to violence on the ground. Every missile, drone, or surveillance system sold puts lives at risk, infrastructure under attack, and communities in turmoil. While the financial gains are real, the human cost is immeasurable. This sector demonstrates the interconnectedness of global finance and conflict. Countries that supply advanced defense technology often gain political leverage, as well as economic benefits. International contracts can influence diplomatic relationships, and investors pay as much attention to these geopolitical signals as they do to quarterly earnings reports. It's crucial for ordinary viewers to understand this paradox. War creates winners in ways that may be uncomfortable or even unethical to acknowledge. Yet the markets reflect these dynamics in real time, a stark reminder that economic systems and human tragedies are often intertwined in ways rarely seen on the news. In times of conflict, fear becomes a currency. Investors worldwide rush to secure what they perceive as safe, tangible, or stable. And nowhere is this more evident than in gold and the US dollar. The Israel-Palestine conflict, like many geopolitical crises, has sent investors scurrying toward these traditional safe havens, seeking refuge from market turbulence. Gold, often called the ultimate insurance policy, surged as soon as news of the conflict intensified. Even minor disruptions in the Middle East can trigger speculative buying as traders and investors anticipate uncertainty. Gold has historically acted as a hedge against inflation and geopolitical risk, and this pattern continues today. The US dollar also strengthens during these periods. As fear rises, global investors move capital into dollars to seek stability and liquidity. Treasury bonds, currency swaps, and dollar-denominated assets often experience increased demand. It's a dance of psychology and economics, where trust, fear, and anticipation shape the flow of money across the globe. But let's pause and reflect on what this means for ordinary people. While rising gold and dollar prices may protect portfolios, they also contribute to higher import costs, more expensive energy, and elevated prices for everyday goods. Effectively, while one hand shields the wealth of some, the other hand squeezes the daily lives of many. It's fascinating how human psychology drives markets. Fear spreads faster than news itself. Investors don't just react to facts, they react to anticipation. imagining the worst-case scenario and adjusting their holdings accordingly. These reactions can amplify the financial impact of a conflict far beyond the immediate region, creating ripple effects that touch lives from Berlin to Mumbai. Moreover, not all safe havens react the same way. Some emerging market currencies may lose value as capital flees, while gold and the dollar become more valuable. Even cryptocurrencies can be volatile, as some traders treat them as alternative hedges, while others panic sell in uncertain times. Beyond traditional markets, another financial battlefield emerges, the world of cryptocurrencies. During times of geopolitical tension, the behavior of digital assets is both fascinating and unpredictable. Bitcoin, Ethereum, and stablecoins react not only to investor sentiment, but also to global uncertainty. They often decouple from conventional markets, but sometimes mirror them in unexpected ways. During the escalation between Israel and Palestine, cryptocurrencies experienced sharp fluctuations. Some traders turned to Bitcoin as a perceived safe haven to protect their wealth from sudden shocks in traditional currencies or stock markets. Others, however, panicked and liquidated their digital holdings to cover losses elsewhere. This duality reflects a broader truth. Crypto is both a tool for empowerment and a mirror of fear. What makes cryptocurrency unique in times of conflict is its borderless nature. Unlike dollars, euros, or national bonds, digital currencies can move freely, offering an alternative store of value in regions where banking infrastructure may be compromised or restricted. For some, this represents hope, a way to bypass conventional financial systems that are slow, bureaucratic, or inaccessible during crises. Yet this emerging frontier is not immune to volatility. Hackers, market sentiment, and sudden regulatory announcements can amplify price fluctuations. Just as in traditional finance, human emotion drives these fluctuations. Fear, hope, and speculation collide in real time, creating opportunities and risks for global investors. For ordinary people in conflict zones, cryptocurrencies can be a lifeline, enabling remittances, access to international markets, and protection against currency devaluation. However, for global investors, the crypto market is just another arena in which to hedge, speculate, or profit. This vividly illustrates how technology and finance intersect with human conflict in previously unimaginable ways. While global investors watch markets and speculate on potential profits, the reality on the ground is starkly different. Those living through the conflict face daily disruptions that far exceed what financial charts can convey. While markets may fluctuate in boardrooms thousands of miles away, families in Gaza and Israel wake up to uncertainty, destroyed infrastructure, and shrinking livelihoods. Unemployment rises immediately. Small businesses, already fragile, struggle to survive amid disrupted supply chains and damaged facilities. Shops remain closed, local markets shrink, and access to essential goods becomes limited. The human cost is immense, yet often invisible to those tracking stock tickers or commodity prices. Aid organizations try to intervene, but the scale of the destruction and the ongoing hostilities make it difficult. Hospitals are overwhelmed, and basic services like electricity, water, and transportation are unreliable or unavailable. Each disruption compounds economic hardship, deepening poverty, and reducing the region's long-term growth potential. At the same time, regional economies are rife with uncertainty. Neighboring countries may experience increased refugee flows, rising demand for resources, and pressure on their own markets. Tourism collapses, trade slows, and foreign investment retreats. In short, conflict reshapes local and regional economic landscapes. Yet amid this hardship, human resilience emerges. Community networks adapt, families support each other, and informal economies develop to meet urgent needs. However, these adaptations cannot fully offset the economic shockwaves of war, which continue to reverberate long after the headlines fade. To understand the financial impact of the Israel-Palestine conflict, it is important to examine history. Wars in the Middle East have repeatedly demonstrated a consistent pattern. Markets react swiftly, certain sectors profit, and civilians suffer the worst of the economic consequences. From the 1948 Arab-Israeli War to the Gaza conflicts of the 2000s, these dynamics have repeated themselves with remarkable consistency. Consider the 1973 oil crisis, for example. when geopolitical tensions in the Middle East caused oil prices to quadruple. Global inflation skyrocketed, stock markets tumbled, and ordinary people faced economic hardship. Defense companies, on the other hand, experienced increased demand and rising stock valuations. Fast forward to the Gulf War in 1990, and we see a similar pattern of market volatility, safe haven surges, and regional economic strain. History teaches us that while human outcomes are tragic, financial reactions to war are predictable. Investors have learned to anticipate risk by hedging against uncertainty through safe havens, commodities, and defense stocks. Meanwhile, local economies often remain vulnerable to long-term damage that can last decades. This historical perspective also reveals a paradox. The same markets that provide liquidity, growth, and investment opportunities also profit from instability. Wars create both human suffering and economic opportunity. Understanding this duality is essential to interpreting today's financial reactions. This cycle repeats due to human psychology, geopolitics, and market mechanics. Fear, speculation, and expectation continue to drive markets today just as strongly as they did 50 or 70 years ago. While the players may change, with new technologies, cryptocurrencies, and international investments, the underlying dynamics remain strikingly similar. After examining the markets, the energy sector, the defense industry, safe haven assets, cryptocurrencies, and the regional economic impact, we arrive at the central question: who really profits from war? On the surface, the answer seems clear. Investors in defense companies, commodity traders, and those holding safe haven assets, such as gold or the US dollar, often see gains. Hedge funds and speculators may profit from volatility. In some cases, governments and geopolitical actors can benefit strategically or economically. Markets respond almost instantly, rewarding anticipation and positioning. Yet these financial profits exist alongside staggering human costs. Displaced families, destroyed communities, and destabilized economies form the other side of this coin. Ordinary people bear the weight of uncertainty, inflation, and unemployment, while profits are quietly recorded on balance sheets elsewhere. The paradox is stark. Financial markets often thrive on the very instability that devastates human lives. This is not an ethical judgment, but rather an observation about the mechanics of our global system. War creates winners and losers, and they are rarely the same people. However, understanding these dynamics empowers us. By studying financial patterns, historical precedents, and human consequences, we can better interpret world events, anticipate economic reactions, and perhaps even advocate for policies that reduce the human toll. Ultimately, the invisible financial war that runs parallel to the headlines is as real as rockets and bombings. This silent war shapes wealth, markets, and economies across the globe, reminding us that behind every number is a human story. So, the next time you see oil prices spike, gold jump, or defense stocks rise during a conflict, remember that these are more than just numbers. They are echoes of human lives, fear, hope, and resilience. Understanding this hidden financial layer won't make war any less tragic, but it will reveal the complex web connecting markets and humanity, and perhaps the responsibility we all share to see both sides of the story. If you found this analysis insightful, leave a comment below. What do you think is the most surprising way markets respond to conflict? Don't forget to subscribe for more deep dives into the hidden financial forces shaping our world.